Welcome back to another edition of Paladin Financial Talk. This is Matt Bryant, along with Tyler Ellegard, portfolio manager at Gradience Investments, and of course, our Tony Shore.
Dr. Tony Shore.
Dr. Tony.
I'm not a real doctor, but I play one on the radio, so that's
Okay.
fun. Yeah.
So
that's
Tyler,
good.
That's fair.
Tyler's a real CFA.
He is.
Well, try to be.
For a little introduction for our viewers, CFA is Chartered Financial Analyst. So
Yeah.
really it's the gold standard in the investment world.
You have to be smart
You do?
and talented and know what you're talking about.
Yes.
And that's Tyler Ellegard.
Yes, and it's really a requirement when we're at Paladin looking around for who should be managing our portfolios. CFA is one of those things that we look for because we know they've been through
Right.
a lot of education.
And you've been through a lot of education yourself, Matt, and had
Yep.
experience on that side of things, but you're also going for your CFP, which is huge.
That's right.
That's a year long, and that's hard, isn't it?
Yeah, be about 15 months, 18 months by the time we're done with it.
Yeah.
So yeah, it's good. But
Yeah.
How far into it are you?
2 months.
There you go.
So we're rolling.
You got to grind.
We're rolling. It's actually interesting stuff though. So looking forward to plowing through the rest of it. But it's been good.
Practical stuff.
It is. It's actually useful stuff we talk about every day with clients.
Yeah,
So
that's good.
it's good.
That's good.
Today we are going to do a little bit of a market recap. So we'll start with talking about what happened last year in the stock markets and the bond markets. And there was something that happened in November that we'll talk a little bit about. And we'll look at where do we head for 2025? What's the outlook as far as stocks go, as far as bonds go, and just kind of get a lay of the land and see what we're up against. So we did a little back and forth prior to this starting, some Q&A. First, Tyler, I'll let you start. Just broadly speaking, how did the various equity and bond markets go last year?
I mean, I would say generally speaking, the markets were good, right? I mean, 2023, now 2023, the market was up 26%. Last year, we finished the year up 25. So if you can have back-to-back, 25, 26% years or 20% plus in general is a pretty rare occurrence.
Yeah, it's unheard of, really, to have
So-
2 years back to back. Those
Yeah.
are huge years.
Yeah. So, I mean, markets were great. The only challenging part with that, it was generally led by the
Right.
large 7-6 companies in the market, which, we can talk about of why. But I think from a broader perspective, the 10,000 foot view level, markets were great. Fixed income was a little bit more challenging.
Yeah.
The Federal Reserve loves the spotlight. So they love to have their speeches and not tell you what their plans are. They're just saying data dependent and let you figure that
Right.
out. So there's a lot of volatility in bonds last year. There's points where bonds were negative, points where bonds were even more positive than they finished, but they generally finished about 1.5%, 2% higher last year.
And if we go all the way back to Q4 of 2023, the expectation was inflation will keep coming down. We'll see rates start coming down, and 2024 should be a decent year for bonds. And we saw, like you said, volatility. They were stubborn. Like things didn't drop as much as were forecasted, which honestly tends to be the story. Things just take longer to actually develop. So we talked a little bit about outlook in our conversations, and we'll cover that in a minute, but I want to step back to the equity markets. You had 2 huge years in the stock market.
Yep.
People tend to get complacent. Like they see, hey, 25% a year, that's easy all of a sudden, forgetting what happened in 2022 and what volatility might look like going forward. So that's something that we try to relay to clients on a regular basis, is don't come to expect 20+% every year.
Well, I mean, the market averages, if you look back over 30 years, 50 years, they all tend to merge around 12% annualized average return on a total return basis. If you look at price returns, about 8 to 9. And the market never actually hits that, right? It's never the amount of times in the last, we did the research, we look back at it over the last like 70 years, the amount of times that the market has actually finished the year at 12% is very, very minimal. And if you even take it on a price return basis, looking at 8% average, I don't think there's been 1 year in the last 50 years that the market has actually finished the year at 8%.
Right.
It's either 1%, 25%, 6%.
That's
right?
funny you bring that up. I was just talking with someone last week that was looking at joining Paladin, and we know what the average returns are historically. And I said the exact same thing. Like, never do we actually get, or rarely, an 8 to 10% return. You get down 22, you get up 23, you get down 4. Like, it's not consistent. So when you talk about managing risk and how you actually invest, that's kind of a big deal.
Yeah. You don't just get every year. If you're in the market, you just get 8%. It just doesn't happen.
Well, that's why anytime you hear anything, whether it's about finances or not, and they say the average, and I know one advisor that I've talked to likes to say, well, I've never met the average person.
Yeah.
That's right.
I don't know. I don't know the average person. You know, the average person made this much. Unfortunately, I don't know the average person.
Right.
And you're not the average person, and I'm not the average person, right?
Yeah.
No, and when you drill it down even further, and we sit down with clients that we work with, no two persons, their plans don't look the same, right? Everybody has different allocations. We'll use a lot of the same building blocks, but they're going to be constructed in a different manner. So coming in and with expectations of, hey, I got 23% last year, I'm going to do 23% again this year, and no volatility, and life's good. Well, if you find it, let us know. But that's a big part of the conversation as we regroup for 2025.
Or, I mean, to build on that point, if you have a prospect coming in that says, hey, my friend who invests with you, they have XYZ stock or whatever in their portfolio, I want that. It's like, well, let's take a step back.
Yeah.
Because maybe that's not what you actually want. Like, the returns sound great, but
there's a flip side to it. With reward comes risk. And it wasn't that long ago that 2022 was a terrible year to be invested. And it was also a year where bonds fared poorly too. So there's no place to hide that year. We've seen a nice rebound on the stock side, but as we look ahead, let's start with bonds. What's the forecast from Gradient as far as where do we see interest rates going this year, and what might that mean for the bond markets?
Well, I think everybody wants us. When I talk about fixed income, I always try to start with the Fed, because that when people hear about interest rates and cuts, that's who's doing it, is the U.S. Federal Reserve, right? So the Federal Reserve right now, the market's expecting about 2 interest rate cuts. I'm more in the 3, potentially 4 camp, depending on how consumers do. But I think if we look at what interest rates are, most people will look at the 10-year Treasury, which is the benchmark interest rate. If you look at historical data and just come up with a yield curve that we typically have for treasuries, the 10-year Treasury is basically right where it should be, based on what the Federal Reserve is expected to do, and that's taking into account my extra 1 or 2 interest rate cuts from the Federal Reserve. So a 4.6% 10-year Treasury is based on historical stuff. Now, obviously, you go beyond you go higher or lower, right? You don't just meet in the middle.
Right.
So my expectation is the 10-year Treasury trades between 4.25% and 4.75%, and we're sitting at 4.6% right now. So, and we topped out the high end just a couple of days ago at about 4.85%. So it was just a little bit above, but I think we just sit in that up and down trading range for the year.
And that's not terrible, right? I mean, it was a lot worse, wasn't it?
A lot worse.
With bonds. I mean, we were upside down with the bond market.
Well, and that's why 2022 is so bad, right? You're coming off of a 0 interest rate environment. The 10-year Treasury, because the Federal Reserve was buying so much of U.S. Treasuries and mortgages, the 10-year Treasury was literally below 2%, I believe, at one point. I think it was like 1.6%. And so to go from 1.6 up to 4.6, that's a big. When interest rates go up, bond prices go down, right? So there's an inverse relationship. So they had to, at some point, it had to reset. We've now reset. And this is actually long-term averages where the 10-year Treasury is at anyways. So,
and you had, I mean, what started this to a large degree was the shock of COVID. They made some drastic changes to try to keep the economy from falling, just going into free fall. So slashing rates to 0 basically overnight. I mean, you have to come out of that. That's why part of the reason we saw inflation shoot up like it did. So now they're actually getting us, I guess, back to a more normalized environment, historically speaking, to your point. So, and it was interesting, like when you would see the Fed come out and say they're cutting rates, there was a lot of days where the 10-year didn't.
Well, so the Federal Reserve is cut by 1% so far from the peak, and actually the 10-year Treasury has gone higher. Right. So, and that's where the difference comes in.
Right. So that's kind of when we sit down and talk, it's like, hey, if you're a saver, higher rates are better. If you're a borrower, lower rates are better.
Yeah.
So depending where you're at in the spectrum, you know, shopping for a mortgage right now is probably not the most fun thing, but if you're sitting on cash and you're just buying CDs or, you know, investment products with low risk and decent yield, that's a great spot to be in. So what tools do you use?
I'll jump in my soapbox here real quick if we've got time for this, but
plenty of time.
Oh yeah.
So, you know, everybody's got the realtor friend and the realtor mortgage buddy that tells you that mortgage rates are coming down. You know, I've heard that from 2022, 23, 24. This year I'm hearing it.
Yeah.
Right. Because the thing is they say Federal Reserve is cutting interest rates, so mortgage rates should come down. But the mortgage rates, the 30-year fixed mortgage rate trades based on where the 10-year treasury is at. So if you expect a 10-year treasury at 4.6%, the typical spread is about 1.5. Right now we're sitting at about 2.5 just because demand isn't there. So you're sitting at about a 7% mortgage rate, and that's right where it should be. So I don't foresee, I wouldn't foresee mortgage rates coming below 6% for the foreseeable future.
Okay. Now that interest rates do tie into how the stock market can perform. We already talked about how we're coming off of 2 very strong years. Last year, I mean, what was the deepest drawdown? We saw a little bit of a correction in the summer, and the December wasn't great.
We didn't
either.
get the full 10%,
close,
but we got about, I think it was like 9.2, maybe something like that.
So, and what Tyler's referring to is even in the best years in the stock market, there will be a period during that year where the stock market declines from its highest point by about 10%, sometimes deeper, but then rebounds. And what we saw last year in the summer was it pulled back 9%. Most people didn't even notice.
Right.
I mean, they're trucking along. It was a 6-8 week event
because the market was up so much.
Yeah.
That people are like, yeah.
I mean, at that point, I think the market was already up 17, 18%. So a 9% pullback. I'm still feeling pretty good.
Yep.
It hurts to see the 9% go away, but
you're
still up 9% on the year.
And it came back more.
Yeah.
It usually comes back even a little stronger.
And then when we've been talking with clients, all right, what do we expect going forward as far as stock returns? There's just strictly looking at 20 plus years in the market, you're due for some sort of pullback. That's just getting things back in equilibrium. So by that token, expect some sort of correction. Doesn't necessarily mean it's going to be a bad year. It's just there's going to be a blip on the radar, which is typical. Then you add in what happened in November. President Trump's back in office. Congress is all Republican now. So there are big things that we are watching that can impact the stock market. One is the Tax Cut and Jobs Act that he passed back in 2017, set to sunset at the end of this year if Congress does nothing. Basically, what that means is income taxes will go up, standard deduction will change, a whole host of other things. But the forecast as far back as or as little as 6 months ago was, hey, that's going to expire, and back to pre-2017 rates. So it's looking more likely that might be extended. What are your thoughts on that?
I honestly think it will. I would give it probably like a 99% probability of passing, and not only because the Republicans control the House and Senate, but you've also heard the Harris campaigned on potentially extending some of this as well. There's some bipartisan to this, right?
I think the standard deduction alone, I've heard both sides say how great that is, the increased standard deduction.
Well, any change, and to your point, it's the extension, it's not additional cuts, right? So so that would mean that, what is it? A 22% bracket goes to 24. And so what all of these parties are looking at is we need to make sure that consumers keep as much money in their pockets, because consumers are 70% of our economy. So if we want our economy to keep going, and none of these congressmen, congresswomen, the presidents, the vice, like nobody wants to have a recession under their belt, right? And so any shock to the consumer on all of a sudden you're getting 2% or 3% or 4% less of your paycheck, that's a big shock to them, on consumers that are already feeling the pain of inflation from 2022. Right. So I think there's probably a high probability that this does go through.
Yep. What do you see as headwinds this year? I hit on already just the fact, regardless of what the political climate is, when you're up that big for that long, something's got to change, at least temporarily.
Yeah, well, we saw this with Trump. We'll call it Trump 1.0. There's a lot of rhetoric. There's a lot of conversations. There's a lot of headlines. But then when it actually comes time for something to pass, it tends to be rolled back a little bit,
muted a little bit more,
right? Yep. So there's a lot of headlines flying around right now, and I think the biggest one is tariffs. We saw, he said day one, I'm going to put 25% tariffs on Mexico, Canada, additional 10% on China. Well, we're past day one now.
Yep.
We haven't seen tariffs yet. So I think he's going to use a lot of the stuff that he's doing. Sanctions on Russia, we heard about that today. A lot of the stuff that I think he's trying to do as far as like tariffs, maybe sanctions, is more to negotiate, right? Bring the other side of the table, because
leverage.
Yes. Yeah. We haven't necessarily had that for quite some time. So I think he's just trying to get us back into that position. Now, whether it works or not, who knows, right? There's rhetoric coming out of Mexico that they're going to hit us with tariffs, right? Yeah. So it's all talk, it's all negotiations. And everybody knows Trump loves to be a negotiator. Yeah. So I think that's going to be the biggest headwind to the market this year. Also, how expensive stocks are in general. We're sitting at, 80th, 90th percentile in valuation right now on stocks. So
it's pretty high.
It's a very high, very expensive market. So I would say I wouldn't say it's priced for perfection, but it's getting close to that. So any miss of these big AI companies on earnings reports, you're going to see some type of pullback in the market because of it.
And going back to your first point about Trump, you alluded to it. It's uncertainty. Stock market hates uncertainty. Yeah. So when there's not when it's not clear what's going to happen with tariffs and what does that actually mean, stock market doesn't like that.
Yeah, so it doesn't like change.
Skittishness, and then that leads to uncertainty, which leads to a decline in stock prices. And just naturally getting back into more reasonable valuations is another thing to look at. Now, it doesn't mean it's going to be a bad year. We're not saying there's going to be a stock market crash. That's not what that means. It means there's likely to be a pullback that gets things back in a more reasonable line.
Some corrections or a little volatility, wouldn't you say?
And then it resets and starts moving its way back up.
Yeah, and one of the reasons the market corrects is people take a breather, right? They pull money out of things that have done well and maybe sit on cash, or they rotate into something else that hasn't done as well that could be a buying opportunity. So back in December, we saw, industrials were down 8% in December, materials were down 12%, energy was down, I think, 14%. Real estate was down 12%, right? So there's areas of the market where the market was down in December, but we only felt about 3 or 4% of that pain because you're diversified, right?
Yeah.
So that's where we can step in and say, this is where we're trying to like pick our poison, if you will, right? We're going to we think there's enough valuation here. We think there's enough growth here. So that's what we're going to target.
And that goes back to what I said at the beginning, is complacency. Like, just because you got 25% each of the last 2 years doesn't mean that's what's going to continue. You need to be mindful of how you're invested, make sure you're managing your risk. And that's certainly what we help with at Paladin. We tap into gradient all the time for that help, but making sure you're rebalancing, making those adjustments, making sure when you have your equities, we're actually leaning in the right direction and not just buying the globe. I asked you prior to this meeting, what's the thought on international versus US? Because for a long time, the US has been the best place to be. We came out of COVID better. We've performed better for the last couple of years, especially. I mean, what's the outlook? Just take Europe versus America.
So this is coming from the international portfolio manager too. So
here we go.
I still would say not the place to be. There's a very different makeup in what makes up international stocks versus what makes up US. It's more financials, more industrials, and a lot less technology and innovation. And if we think AI is going to be this wave of the future, give us more efficiency and where people want to invest their dollars, Europe and Japan, and you could maybe throw China in there, but most of the rest of the world is not where you really want to be. And there's some economic stuff going on in Europe as well that, you probably don't necessarily want to be a part of. Not to say that every stock is going to do bad.
No.
But if you're going to say, I want to be in the best area possible, I would say US is still the crowning jewel.
High quality US stocks, manage your risk. look under the hood of what you actually own. That's one of the big things we do when a new person comes to us is how are you actually invested? We ask the question. Sometimes the answer we get is vastly different than what they actually have. So we're able to look under the hood, see where you're allocated. You can get really nitty gritty on some details that nerds like us like to look at, but how do we fix that going forward? Because it's not going to be as easy investing over the next certainly 12 months as it has been the last 24.
Yeah.
So that's good. I think that's enough for today. We have a couple things coming up. Jeff Foley is going to be doing the podcast next week talking about real estate. But he's also going to be doing a webinar talking about the markets as well, but also annuities, which fits a role for some of our clients. And then we have a client event coming up where we're going to talk about taxes, understanding your taxes, what might future tax changes look like. So stay tuned for that. But today was meant to be a recap of the markets, a little bit of an outlook, because it's not going to be a smooth ride like it has the last couple of years.
Well, Matt, what a huge get for the show today.
Yeah.
To get
I had to pull some strings.
Portfolio manager from Gradient Investments, Tyler Ellegard.
Let me leave you with this. So my official outlook on the market, just a thought here. I'm not going to make a pinpoint on where the S&P is going to finish, but I would say this year you probably get about 6-ish% total return in the market.
You couldn't say 8. You couldn't say the average 8 to 12.
Couldn't go with 8.
So
can't go with 8.
Good. We've talked about it. Doesn't mean it's going to be a bad year. There's going to be volatility most likely,
but maybe some buying opportunity. You don't want. I think the evaluations you talked about, the valuations and where it's at. I mean, Nvidia. How high can a stock get before it's just overpriced and no one can afford to get? People see, I want Nvidia because the headlines. CNBC says Nvidia stock up X amount. Or the Mag 7 are carrying it. Well, I'll put all my money in the Mag 7, but how much are you able to buy of the Mag 7 right now because they're so expensive? Versus, I want to see a correction because I'm still if I'm in retirement, I don't. But if I'm now at my age, I'm like, hey,
average,
I need to make some money in the next 13 years. So I want to see some corrections because I'm dollar cost averaging my way into the market, right?
Yep. And
is that right?
We see that. I mean, we have a lot of people still working, we have a lot of people in retirement. And that's why you actually need to look specifically at how you're invested and what type of portfolios you're.
And if there's a pullback or a correction this year, and you're still in your working years, great opportunity.
Yep. So
wouldn't you say so, Taylor? Or am I talking crazy?
No, absolutely. Absolutely.
Okay. Because you're giving me a look. I don't know if that's encouragement.
I found it funny. So just so you know, you've got Tony. You got to do podcasts with Tony for 13 more years.
That crossed my mind. I'm like, wow, get some fresh blood, but I guess not. So no, it's all good. Tony.
I'm gonna keep co-hosting podcasts and radio shows as long as my voice holds out. I'm warning you right now, because I love what I do.
That's good.
I mean, I say that, and then I make plans. God laughs. Maybe my health or my voice won't be good enough. Maybe I'll only do it another 5 years. But I'm thinking till I'm 70 at least. Right. Yeah,
sounds good so far.
I mean, these golden pipes are only getting better as I age. Right.
Well, thank you both. I do appreciate it. We look forward to another 13 years of Tony. This is Paladin Financial Talk. If you need to get a hold of us, we'd love to have a conversation. PaladinFinancial.com, of course, or 651-842-8406. We can dive even deeper on your scenario or talk whatever markets that you want to do, but hope to hear from you and have a good one.
All right. And thank you to our guest, Tyler Ellegard, portfolio manager at Gradient Investments. And of course, our host, the man with the plan, Matt Bryant. That does it for today's episode of Paladin Financial Talk.